I'm Taylor Riggs in San Francisco, in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, this is it. Big tech earnings tumble out all week. Facebook, Tesla, Amazon, all reporting. We start with a preview of Tuesday's biggie, Apple. Plus, searching for the cure. Biotech may be the key to helping cure the potential deadly coronavirus. We'll talk to U.S.-based Inovio on the front lines of finding a vaccine. And taking a bite out of competition. TikTok rival Byte jumps into the video sharing app wars. Details just ahead. But first, to our top story, and it is the S&P 500 declining the most in almost 4 months, with energy and technology companies leading the losses. That's due to concerns over the impact of a deadly virus that originated in China, and it is rattling global markets. It also comes at the same time as the S&P goes into the busiest week yet for earnings, with some of the largest tech names reporting. Joining us to discuss it is Craig Johnson, research analyst of Piper Sandler. Craig, thank you for joining us. I wanted to talk about today's action first. You have the stocks off about 4%, the NASDAQ off almost now 2%. In your opinion, is this a buy the dip opportunity, or do we expect sort of a bigger correction to start happening?
Taylor, thanks for having me on. I think this market right now is one where we're going to get a little bit of a deeper correction. As I look at this entire market, this is a market that we have been thinking has been overbought for quite some time. In fact, we put out a piece earlier this month and we titled it "I'll Melt With You," kind of a play on the words from a popular song back in the 80s. And from our perspective, all the conditions were right to see this sort of 5 to 10% correction in the market, and the coronavirus was actually the event that finally triggered that sell-off and profit-taking in here. So it's going to be a little bit deeper of a pullback. I would not be surprised to see a pullback toward the 200-day moving average, which would get you to about 3,000 on the S&P 500. So look for some more back and filling and profit-taking.
Craig, I want to take a look at a chart here that I'm showing inside my terminal. It's a forward PE ratio. We talked a lot about how valuations were really full heading up into this moment, particularly since the stocks had run up 60% last year. Today's decline only brings us down to a forward PE basis of still over 19 times on the stocks. Do we still look fully valued at these levels?
Yeah, I think we still look fairly fully valued, because if we take not only the earnings for the entire market, but we had negative earnings in Q3, and we're on a pace for negative earnings here in Q4. 2 quarters in a row would suggest you got a negative earnings or an earnings recession starting to unfold. And so from that perspective, I still think there needs to be a deeper correction. When you look at our year-end price objective of 3,600, that's going to have to see some earnings pick up in here to get there. And the earnings multiple, I'm not sure we're going to see multiples on the market expand, upwards of 23, 24 times earnings to get to those kind of levels. So we do need to see earnings pick up. And if not, this market is going to have to see a bit of a deeper pullback.
Craig, I want to dive into some of the individual sectors. I found it very interesting in your note that within tech, it is not one shoe fits all. You are overweight tech, but then you're underweight communications and media. So you are not a broad-based bull on all things tech. Why the difference? What do you like and what do you not like?
Sure, and the rationale for that, Taylor, is that we take the entire market and we put it into a normal distribution, looking at total return relative strength. And when we go through that process, we do the trend analysis of what we're seeing. And when we look at the communication media space, we're not seeing as strong of a relative strength trend there as we are seeing in the regular part of tech. And when I tear apart that communication media space, I look at things like Verizon. They're not really putting up great relative performance. They got a nice dividend, but it's not one of the more exciting places to be. When I come back into the technology sector itself, I see lots of outperformance happening in the semiconductors, and I see things in the drive space, such as Western Digital, that looks like a constructive looking chart. So I can kind of pick apart these sectors, and I'm seeing some clear relative strength winners and some clear relative strength losers as I go through our work.
You know, Craig, I want to get into some of the individual companies that are reporting this week, Apple being the first, coming out Tuesday after the bell. A lot of people said it is the rate at which this company has moved. You're up 100% in the last year or so. And on a log chart, it does indeed look parabolic, as you mentioned. Did this stock get ahead of itself, ahead of earnings?
From my perspective, I think the answer is absolutely yes. And when you look at this chart on Apple, the one thing that strikes me is this reminds me of January of 2018. And this was a period of time where we raised our hand and we said, enough is enough. Charts like Caterpillar, 3M, Boeing, were all going parabolic at that point in time. And if you look at all those charts today on a weekly chart basis, they've had very meaningful corrections. So I look here at Apple and I look at some of these other tech leaders. They're clearly great companies. And I love all the Apple products. Even though my wife is tired of hearing about me buying more Apple products, great company. I'm just not sure it's a great stock right now at this point in time. Right. And I think you can get a deeper correction in this name.
I want to continue on and push forward as well to Amazon and Microsoft, which we'll be reporting later. Seems like sentiment has really shifted from Amazon and the web services sort of not having the cool factor to Microsoft and their cloud business really taking on, especially with that Jedi contract. Your thoughts on the cloud businesses as it relates to an Amazon and a Microsoft?
Sure, and if you take a look at the charts of both of these, and if we first start with Amazon, that chart has just really been consolidating sideways now for the better part of the last 12 months or so on a relative basis. I like what I'm seeing with Microsoft. The trend is still much stronger with Microsoft than what I have with Amazon. So the cloud business at Amazon and Microsoft, those have been the drivers for these companies, but it looks like Microsoft is moving ahead from that perspective and showing some better relative strength. So from a chart perspective, we're better off and generating better alpha with Microsoft right now than we are with Amazon.
If you mentioned parabolic, I think there's another company that you've done some recent work on, that is Tesla. It is that rate of change really in the last 6 months that have caught, I think, a lot of people off guard. What drives Tesla forward? Is it the fundamentals as we await earnings in February, or more the technicals and that rate of change at which we've been seeing?
Well, I'm not sure it's the fundamentals. I mean, it's becoming a cult stock at this point in time, and so you're getting a lot of hype into this company. There's a lot of people that really believe that Tesla is going to change the world, and you look at the chart, that's fine. Clearly a lot of great things are happening, but here's another great example of a parabolic start. And so as we go through and look at this and we say, it's a great company, but is this where you put fresh, new money to work? And from my perspective, the answer is no. And I think we have to really distinguish between the fundamentals, the technology, and where do you put your hard-earned dollars to work to get the best return going forward. Tesla's fine. You need to wait for a correction in that price to be more reasonable. It's had such a rapid liftoff and acceleration that it does not look like it's sustainable. I mean, we're not going to see this stock, grow to the moon at this point in time.
Craig, I think another thing that concerns people within the S&P 500 is the dominance of the tech sector, that more and more of the S&P 500 is dominated by bigger and fewer large names. If there were to be a correction, or if earnings weren't to match some of these high expectations, does it concern you about how dominant the big tech companies are within the broader market?
The answer is absolutely yes. And if you just take, again, coming back to Apple, most portfolio managers cannot own a full position of Apple in their portfolio. Risk management will come in and say you can't own 5-6% position of just Apple. So what you've been seeing happening across the board is they'll buy up to the limit that they can buy, and then they will turn around and they'll start buying individual stocks that kind of are in that ecosphere for Apple, and they'll build up their position to kind of create a proxy position for Apple to try to keep up with the overall benchmark. So when Apple comes out and reports results, if those results are not great and you've already got a parabolic stock, a lot of expectations are built into it, then you're going to see many names inside of tech correct, not just Apple, but many names, as people have been trying to play the components for Apple and the suppliers as kind of a proxy to get their exposure. So that does worry me.
Craig Johnson, yep, wonderful. Craig Johnson of Piper Sandler, thank you for joining us. And coming up, containing the coronavirus, we'll speak to the co-founder of one biotech company racing to find a vaccine. All of that next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Cisco has named AMD CEO and President Lisa Su to its board of directors. Su joined AMD back in 2012. 2 years later, she became CEO and president. She also serves on AMD's board of directors. Su is now the 11th member of Cisco's board. Now, the deadly coronavirus has killed at least 80 people in China and sickened more than 2,700. The illness has appeared in more than 15 countries around the world, and researchers are frantically working to come up with remedies. One of the firms trying to do just that is Inovio. And last week, the Philadelphia-based biotech firm received $9 million in funding from the Coalition for Epidemic Preparedness Innovations. Joining us now from Philadelphia is the co-founder of Inovio, Dr. David Weiner. In 2014, he was named as one of the nation's top 40 most influential vaccine scientists. So, Doctor, it's great to have you. Talk to me first about what specifically you're doing with that $9 million grant to help find a potential vaccine for this.
Thank you so much. Inovio, immediately working with CEPI, set up a group, a coalition of people to work together to develop a vaccine candidate that could be moved into clinical trials rapidly. And Inovio has done this 3 times recently in outbreaks, including for the Ebola virus outbreak of several years ago, and the MERS, which is another coronavirus which was moved to the clinic with Walter Reed, and then the Zika vaccine, which was moved rapidly into the clinic, and all 3 of these produced immune response in human beings with the type of immunity that might be associated with protection against these pathogens.
Yeah, you mentioned Ebola, MERS, Zika. What did you learn from all 3 of those that you could potentially apply to this new outbreak of coronavirus?
So Inovio works on synthetic DNA that is rapidly, basically assembling synthetic DNA sequences that code for mimics of a part of these pathogens. And through those 3 trial, basically, systems I talked about, from Ebola, that took about 18 months to develop from scratch a vaccine that protected in the right preclinical models and was moved into the clinic through the entire safety process. And then MERS was about 11 months, also making sure to hit its preclinical benchmarks. And then Zika was among the fastest ever, which was just under 7 months from no program through animal models and development and then into the clinic. And all 3 taught us a lot about the consistency of the immune responses. They all had no significant adverse events associated with this rapid translation development. They all had protective theoretical levels of immune responses in those studies.
Given that this is a technology show, we often wonder sort of about the technology behind it that you've used to develop some of those other vaccines as well. I just wonder, how do you decide what is effective, what isn't?
I think that's a really important question. Our experience through, I guess, the 2 most recent, the Zika really helped us get down selection and translation. And the platform that Inovio has developed, this rapid synthetic, non-live, non-replicating, non-spreading platform, which mimics a small piece of the pathogen, it really has gotten a lot of experience. And now we have a lot of confidence in moving these forward rapidly, and then how to test them and study what immune responses are directed against which regions that are likely susceptible on the virus, therefore making the most contribution.
It was interesting that China was working, I believe it was AbbVie, on one of their HIV drugs to help use some of those to help treat or to help vaccinate or provide an antidote for this. Was China faster in their response this time around relative to some of the other countries? What do you make of the initial response?
I think just looking at CEPI, who you mentioned earlier, how fast they've really jumped in and funded groups to make a prototype and a a first approximation of a vaccine and that we can test right away. I mean, just only a few weeks from the initial cases receiving attention, that's quite a difference from the past. And then working together with the teams to try to accelerate moving that into the clinic in a safe and effective fashion. Those are some of the examples, but I think that the interest in different approaches and drug development and reapplying drugs that may be in other situations is quite heartening.
I wonder, in your expert opinion, what is the best outcome for this? Are you looking for a cure? You're looking for an antidote? You're looking for something to just help alleviate or reduce the symptoms? As you take a look at this, what would be the best end result?
I think the best end result would be similar to programs that normally take much longer times. I mean, vaccines can just prevent us seeing signs of infection or any manifestation of disease when they work well, and so what we're doing here is applying a more rapid technology on a platform that's very rapid to see if we can get to that endpoint faster and provide a tool during this outbreak that people can test right away and hopefully impact this current outbreak, which would be a major help. And I'm sure that's what all the developers that you're mentioning are thinking right now. Let's get in, let's provide a useful tool, and let's have it impact and perhaps prevent spread and disease in this outbreak right away.
You know, and finally, through the technology that you're using, how do you determine if this outbreak has pandemic potential or not? Do you have the technology to really be able to study these outbreaks?
Well, I think that there's many people around the globe studying how fast it moves and how fast it spreads. You mentioned there's just under 3,000 cases now reported and 80 deaths, which I think is interesting and lower than the other two coronaviruses, at least in the death rate, which was SARS was much higher, and so was MERS. So that's important to know. And I think how fast it spreads, and that will be monitored and will be kept up to date by those global surveillance networks.
Dr. David Weiner, co-founder of Inovio, thank you for joining us. And coming up, another pioneering startup whose losses have grown along with its revenue, Casper, now seeking to go public. We'll have more details next. This is Bloomberg. Bird, one of the world's largest providers of electric scooter rentals, is using wintertime, when few people ride scooters, to prep for expansion. The California-based startup is acquiring Cirque, a German rival, for an undisclosed sum. It is now valued at about $2.5 billion. Bird will add more than 300 employees in Europe, getting closer in the region to competitor Lime, which is another U.S. startup. Since launching in London in 2018, the firm has struggled to deploy its scooters there due to tight regulation. Now, online mattress retailer Casper is seeking an IPO valuation at just over $744 million, a drop from its heyday of about $1.1 billion. In a regulatory filing Monday, the startup plans to sell 8.35 million shares for about $17 to $19 each. This makes its assessment short of that $1 billion needed to be a unicorn. Founded in 2014, Casper popularized the so-called bed-in-a-box industry. To discuss the first closely watched IPO of the year, I want to bring in Bloomberg's Leanna Baker in New York. Leanna, why the drop in valuation?
It's about a 30% drop, and it's all about the timing. That $1.1 billion valuation that Casper had came in March 2019. That was before the whole WeWork debacle and the aftermarket performance of Uber and Lyft and Peloton and all these unprofitable internet-focused companies that just did not impress public market investors. So it makes sense that the advisors on this IPO are trying to tell the company, look, why don't you have a more conservative valuation to appease investors who have more scrutiny for these companies.
Is this being seen as a bellwether for future internet tech startups that are trying to go public as well?
Definitely. We're still in January, and it's going to be a long year ahead, and this is sort of that first consumer brand name that people know. We've all seen the advertisements. Casper's everywhere. And if it performs well, it could mean that companies like Postmates and DoorDash and other unprofitable names that are known by consumers and advertise a lot, they'll see whether, it's warm out there in the market for them to also go public.
So the biggest issue is everyone thinks that they have a website, and so now they're a tech company because we want the valuation of a tech company. Is this a tech company or a mattress company?
It's a great question. If you go through the IPO filing, you definitely see that it's a tech-enabled business. There is an R&D center in San Francisco, and they're trying to develop new products besides mattresses, like special lights that you put by your bedside. So the company is investing in technologies. But at the end of the day, they make mattresses and they've opened retail stores all across the country. So it really is one of those companies that's a hybrid, and it's in the eye of the beholder whether it's valued like a tech company or a consumer company. It harkens back to the meal kit craze. You might remember Blue Apron, HelloFresh, and all those companies. Were they tech companies or consumer companies? It's hard to say.
Should we be comforted by the fact that revenue grew 20% and losses only grew 5% in the same time period?
There were some highlights in the IPO filing and in its financials. It has pretty good margins in the high 40% range. So it does make money off these mattresses. Its retail locations, they say, are very profitable. So it is making money. It's just right now not able to turn a profit. And it says it may never turn a profit, which is something that's pretty common in a lot of these IPO prospectuses.
Right. Have they given us any hint that could they be profitable if they wanted to?
There's no indication, but investors might want to look at Purple, one of their rivals that went public a few years ago through a reverse merger IPO, and that company is profitable. So I'm sure that Casper would like investors to look at that just as some sort of model for them to base themselves on.
We only have about 30 seconds. Wanted to get your thoughts on another big story today. The rollback of the Volcker rule means that you can be a little bit more lenient within the venture capital world. Do you assume now more money flowing into VCs, more money flowing into startups, and creating more private, hefty, lofty valuations?
Banks have been investing in startups for a long time. This is just a new avenue for them to invest directly in venture capital funds. So it's been in the works a long time, and we'll see. But will Goldman Sachs be investing as much as SoftBank in private companies and venture capital? Probably not, but it's definitely something to watch.
Bloomberg's Leanna Baker, thank you for joining us. And coming up, TikTok now has a rival, and it's a reboot of an old favorite app, Vine. We'll take a look at it next. This is Bloomberg. This is Bloomberg Technology Global Link, where we join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Taylor Riggs in San Francisco with Sherry On in New York and Paul Allen in Sydney. Let's take a look at those top global tech stories of the day. Paul?
Thanks, Taylor. As the coronavirus outbreak accelerates, global firms in China make moves to protect their employees and limit the virus spread. Automakers like Honda, Peugeot and Nissan are evacuating workers and their families from Wuhan using chartered planes. Retailers and restaurant chains, including McDonald's and Starbucks, have also shut down several stores and warehouses in the region. Volvo is counting on tripling sales of its plug-in hybrid models this year as a way to avoid paying European penalties. The car maker could pay up to hundreds of millions of euros in fines for the sale of its more polluting yet popular combustion engine SUVs. Volvo's CEO Håkan Samuelsson says a fifth of all new cars sold in 2020 should be plug-ins or all electric, compared with just 6.5% last year. French IT services company Capgemini has secured enough shares to go ahead with its plan to take over Altran, another Paris-based engineering consulting firm. Capgemini CEO said the Altran deal will help address an engineering shortage in Europe and the US that has left tech companies short on employees. And those are the top global tech stories that we're watching. Sherry, Taylor.
Paul, thank you. A new rival of TikTok has emerged, and its predecessor is no stranger to fans of video sharing apps. Byte is created by Dom Hoffman, who also co-founded the popular app Vine in 2012 and sold it to Twitter later that year. Byte has rocketed to the top of Apple's App Store in the U.S. since Friday and still maintains its spot. Joining us to discuss is Bloomberg opinion columnist Tim Koppen here in New York for a change. It's great to have you in the studio, Tim. So we saw Twitter having to shelve Vine a couple of years back, right? Because they couldn't make it profitable. So how will Byte be any different?
Well, yeah, that's the thing with Vine. I mean, it was only going a few months before Twitter bought it, less than a year. Twitter took it over and kind of tried to run it, but it never really quite worked out. One of the reasons it's considered that Vine was shut down by Twitter is they couldn't monetize it. The people who were running Vine at the time were a little bit opposed to running branding ads and so forth, other things. So eventually it just kind of died a slow, painful death. But it's still really strong in people's hearts and minds. A lot of people have a certain amount of nostalgia for Vine. And so Dom Hoffman decided he would bring it up. It was originally called V2 when it was kind of in an alpha mode last year. It was delayed indefinitely for a while, and now it's hit the streets, so to speak, under the very interesting name of Byte, because let's remember that TikTok, their biggest rival, the parent company, is called ByteDance. So I think that is not a coincidental name there.
Right, Tim, so talk to me more about that, because the name cannot be a coincidence. Are they trying to be a real competitor here through the name alone?
I think the very fact that we sit here in a studio and we mention the fact that they are almost the same name or very similar name, it really is the kind of thing they're looking for. They're looking for that virality. They're looking for people to remember Vine with nostalgia, but also think of TikTok and ByteDance, which is really such a strong app now around the world. It's one of those few examples of a Chinese company having a really big impact overseas, especially in North America, which is such an important market. So the naming, well, maybe it's coincidence, maybe it's not, but certainly people are talking about it. The formats between, Byte and TikTok are a little bit different, but there's a lot of similarities. And so I think what we'll find is consumers will be using both at the same time, and over time they'll have a preference for one or the other, in the same way that people tended to have a preference for, say, Snap over Instagram. But the other thing that's really important to remember about the new product, Byte, is that they're trying to get some key influencers on, key content creators on. And so the battle between TikTok and Byte to try and get those key creators on will be very, very intense.
So what is Hoffman's aim here in bringing this back? Because in their community guidelines, they keep emphasizing that they have a modest budget. So what does this mean? Are they really trying to make money off this, or is it just for the nostalgia?
I think he's trying to make money off it, but he's playing on nostalgia. That'd be my guess. There is certainly that feeling of Vine was great. When it went away, people were really kind of heartbroken. But there's, it's kind of an older demographic, basically. The people who are really big on TikTok now probably don't even remember the Vine era. Although, interestingly enough, Musical.ly, which was the predecessor to TikTok, they bought off Musical.ly. They were launched at about the same time, so actually very similar age. But in terms of the demographic of TikTok, it's pretty young.
Tim, what are the implications for TikTok here in the U.S.? We know that they're under CFIUS review. They're trying to search for a new U.S. CEO to help sort of revamp their image, not be seen as a company that's owned by another company that's based in Beijing. Is TikTok really nervous here about this new competition?
Well, it's only early days, but you know what? I think there's a counterintuitive way to look at it, and that is if TikTok comes under the microscope more and more and more about being so dominant in America, having so much control over user data and so forth, they could turn around and look at Byte and say, hey, we're not the only ones in the game. There are others around, these new competitors coming along. So quite often when you look at it from a legal standpoint or from a regulatory standpoint, it actually helps to have a competitor, a solid competitor out there. Sure, maybe they'll steal a little bit of advertising money, and it'll pressure them to increase rates that they pay content providers. But if they're looking at the bigger picture, the regulatory framework, I think that this might actually be a good thing for ByteDance and TikTok.
Is the older demographic of, I was going to say Vine, but Byte, one of the reasons why its interface is so simple as compared to TikTok?
Well, it's too early really to know what the demographic for Byte will be. It's a very, very young app. It's basically a week old. But I would certainly say that there's probably room in that higher demographic and an older demographic. And we're talking like 25 and above is an old demographic in this space.
Right.
I do think that there is room for both. And so I think that they will probably find the demographic that works for them.
Thank you to Bloomberg's Tim Colpin. Much more ahead, so stay with us. This is Bloomberg. The official Twitter accounts for more than a dozen NFL teams have been hacked. less than a week before the Super Bowl. A group called Our Mind claims responsibility for the breach, posting a tweet on the Green Bay Packers account page. The group has previously been linked to other Twitter hacks, including CEO Jack Dorsey's account. A Twitter spokeswoman confirmed the NFL hacking and said the company has locked the accounts and is investigating further. Now, this week marks the launch of Bloomberg Green, using data and in-depth reporting to illustrate the scale of climate change. And now we're looking at how Amazon employees aren't shying away in their fight with management over the company's climate policies. This time, it was more than 350 workers putting their names to paper, calling out Amazon for not doing enough to cut ties with fossil fuel companies, writing things like it is unconscionable for Amazon to continue helping the oil and gas industry extract fossil fuels while trying to silence employees who speak out. And this one, hell, if Microsoft can do it, go carbon negative, why can't we? Joining us to discuss, Bloomberg's Matt Day, who covers Amazon, and today joining me in studio. What is this fight really going on? Break it down for us.
So this group of employees started organizing more than a year ago to try to push Amazon, which up to that point hadn't been very transparent about their climate goals and their environmentalism, to really do more. And so we've seen Amazon step up and take many of their recommendations to heart. But these employees are kind of escalating their conflict, saying, listen, we don't think you go far enough. There's much more to be done if we're going to be a truly climate-forward company.
Well, and Amazon saying that we've been trying to do some. They come out and said that they've pledged to be carbon neutral by 2040. The employees, though, clearly not saying that's enough. Has Amazon not done enough, especially when you look at other tech companies that are making similar pledges?
That's certainly the activist opinion. And if you talk to folks involved in corporate sustainability, they say there's definitely some more avenues Amazon could pursue. The employees have made a big deal about entanglements with the oil and gas industry. Amazon's cloud computing division still provides services to big oil and gas drillers. The employees have also pushed for the company to sever ties with lobbyists who have had a kind of an iffy record on climate change. So there's certainly more on that laundry list if you look at what an environmentalism's wish list would be for the company.
Well, and it's interesting, as we talked to Brad Smith over at Microsoft, he made a pledge not only to be carbon neutral, but then to be carbon negative and reduce or take out all of the carbon that they had emitted out of the atmosphere in X amount of years. Do you see Amazon now feeling more and more pressure to do similar things, to make similar steps as other employees now and other companies have put more pressure on them?
Oh, it certainly ups the ante. But I think what Amazon would say, and especially in the Microsoft comparison, they're just very different businesses, right? Amazon will fly packages and drive packages around the country, far more carbon intensive than most of what Microsoft does. So, and I think that just underscores the challenge that they face. They are a really big contributor to greenhouse gas emissions, and they've said they want to get rid of that by 2040.
Talk to me about those more specific challenges, because when we think of Amazon, and one person even note, Amazon's main principle here, it's customer obsession, right? It's all of that, the same day shipping, the free day shipping, you're receiving 12 different items in 12 different boxes. How has Amazon sort of made progress on that?
So you're exactly right. They face a huge challenge because their priority is to get you what you want as quickly as you can ask for it, I suppose, which traditionally has not been compatible with sort of green initiatives. And so Amazon has, their first big step is to electrify their fleet, getting those packages to customers. But I think there's a lot more to come. The people are still waiting for them to check the boxes on how they're going to exactly get there.
And you mentioned a lot of the oil and gas industry as well. That was as well mentioned in here in some of the complaints that the employees were posting online, talking specifically about the oil and gas industry. How is Amazon currently working with them? What would the employees like to see?
So Amazon's cloud group, Amazon Web Services, like the rest of the industry, is providing services to big oil and gas drillers, right? And the activists would have them sort of sever that relationship entirely. Now, what Amazon will say is, listen, we think our operations are more efficient than what these companies use today. So just by using us, they're probably getting an environmental benefit. But as the activists would point out, that's still in the service of getting more oil and gas out of the ground.
Matt, what about the cloud contract that they lost to Microsoft, that JEDI cloud contract, where you see now more tensions between management and employees? The employees are saying that we don't want to help them out with this. Management saying, well, we're going to fight because we want to do it anyways. Where does that put us in the tension between management and employees?
Well, this is definitely something new at Amazon, or at least it's new in the public eye. Like traditionally, it's a company where folks keep their heads down and do their business. In contrast to companies like Google in the Bay Area that really have a history of employee activism. And so I think the ball's really in Amazon's court for how they're going to react to this latest escalation from employees, because we just haven't seen this before in such a public manner from the company's own workforce.
Does this set up Amazon on any potential legal battle where you have employees coming out with a 50, 60, you name it, page document coming out all saying on paper, on the record, we do not want this. Amazon saying, please don't talk to the press without getting our permission. Where does this set them up on any potential legal ramifications?
That's a great question. We certainly haven't seen any lawsuits flying around yet, but certainly the employees are drawing a line in the sand and saying we don't agree with this corporate policy. So I guess if it comes to terminations, we'll see. But at this point, there's nothing in the courts yet about it.
Okay, well, Bloomberg's Matt Day keeping us honest on everything. Thank you for joining us. And as a reminder that as climate change becomes a defining issue of our time, Bloomberg has launched Bloomberg Green, which uses data and in-depth reporting to illustrate the scale of the challenge. Find that on the terminal, online, and on Bloomberg TV and radio. And speaking of leaving fossil fuels behind, General Motors' Detroit plant is set to go all electric next year. The automaker committed to investing about $2.2 billion in the factory as part of a new labor deal. GM's president, Mark Roos, spoke with Bloomberg's David Weston Monday about what to expect from the all-electric venture.
We're redoing the whole plant here to be our highest tech, most forward-looking plant. Everything from our battery electric trucks to the new Cruise Origin, which is our autonomous vehicle that we announced last week. So it is a complete retool of the plant, from body shop to general assembly to the whole infrastructure of the plant. So $2.2 billion in that, and then we'll see a lot of money outside the plant from a supply base to support it, and a lot of jobs. So 2,200 jobs will be put back into this plant. So we couldn't be happier. It's right down the street from the headquarters, and then if you look in Warren, we're developing Warren, Michigan, which is right up the street. We're really developing all of our new battery chemistry and our new technology with electric motors, and the whole EV platforms we'll be introducing here next year in this plant.
So give us a sense, Mark, of when you will be actually rolling those electric vehicles off the assembly line in Hamtramck, and what's the first one going to be? Is it going to be that electric Hummer that we've heard talk about?
Well, there's been a lot of speculation and rumors on that, David, but I think you should watch the Super Bowl, and maybe you'll find out a little bit more about that. But the first vehicle here, which is our battery electric truck, will be produced late next year. So we're on a very fast timeline. We have been. Our battery chemistries are ready. We announced a joint venture in manufacturing here in Ohio, which will be some of the cell production for that. And then in Brownstown here as well, where we do some of our batteries for our electric products. So it's really, we're creating, again, a very high-tech scenario for the Midwest and here in Michigan and in Ohio. And, we've invested billions of dollars, probably $29 billion since 2009. And that's a lot of money back into America, and we're just going to keep doing that. So it's very exciting for us.
How many different types of vehicles will you be making in your new electric vehicle facility there in Hamtramck?
Yeah, we haven't announced that yet, but I can tell you this. It will be multiple brands, multiple styles of trucks. So not only pickup trucks, so there'll be SUVs. And then, finally, we'll have our Cruise Origin, which will be our autonomous vehicle for rideshare. And, it's really going to be something that is both ends of the spectrum in both, the highest technology available in autonomous vehicles, but also our mainstream conversion to electric trucks.
That was General Motors President Mark Roos speaking to Bloomberg's David Weston. And still ahead, tech earnings season is underway. We bring you a full preview of what to expect from Apple's report. That's next. This is Bloomberg. Apple is heading into earnings doing an about face from a year ago. Despite CEO Tim Cook cutting its revenue guidance in 2019, analysts are now bullish going into 2020 on 5G, AirPods, and streaming. Let's bring you the details. What a difference a year makes. Just 1 year ago, Apple CEO Tim Cook sent a letter to investors saying the company was cutting its revenue guidance due to an unforeseen slowdown in China. Tim Cook highlighted a major shortfall in lower iPhone revenue due to fewer iPhone upgrades than anticipated. He added the watch and AirPod sales were also constrained. 1 year later, and Wall Street has done an about face. Analysts have 27 buys on the company and only 7 sells, according to Bloomberg. So what are they expecting this time around to fuel the bullish sentiment? Surprisingly, iPhone revenue. Despite the company saying it wants to transition to services, 52% of revenue still comes from the mobile device. Morgan Stanley's Katie Huberty is the latest analyst to raise her price target into earnings. She says Apple customers now appear poised to replace their smartphones sooner, and features like a longer battery life and 5G technology imply that replacement cycles cannot increase much further. AirPods are another big reason for bullish sentiment. Apple said AirPods shipments are set to double to 60 million in 2019. Analysts at Bernstein said AirPods have outpaced the unit growth trajectory of the original iPhone and watch. Bernstein predicts AirPods generate $15 billion of revenue in 2020. And finally, Apple TV Plus. Apple was one of the latest to enter the crowded streaming wars in late 2019, with the service debuting at $4.99 a month. At that low price, analysts think Apple TV Plus is priced for subscriber gains, not margins. But heading into earnings at a whopping $1.4 trillion market cap, anticipation is high to see if Apple revenue can meet expectations across the iPhone, wearables, and services. For more on what to expect out of Apple's earnings on Tuesday, we're joined by Bloomberg Technology's Mark Gurman, who covers the company. Mark, as much as this company wants to say they're a wearables or a services company, 52% of revenue still comes from the iPhone. What numbers do you need to see out of hardware and iPhone to make sure this meets those lofty expectations we have really going into tomorrow?
I mean, first thing I'll say to your point, any way you slice it, this is the iPhone company, right? You buy the iPhone hardware, and then everything is built around the hardware. The Apple Watch and the AirPods are 100% unusable and irrelevant without the iPhone. You need an iPhone to really use either of those products. In terms of services, right? Services, the device where the services are used most is the iPhone as well, whether that's Apple Music, TV Plus to some extent, Apple Arcade. So regardless of all this talk about services and wearables, the iPhone is the company. Now, to answer your main question, the numbers that we need to see is we either need to see a little bit of growth or stagnant in terms of hardware unit sales. If you remember a year ago, the iPhone dropped 19% year over year. This time we're looking at either being no drop around 0% or negative 1 or 2%, which would be fine and a big improvement from last year's situation.
Well, and the opposite really from negative or stagnant growth would be exponential growth, which is something we've seen from the AirPods, as you mentioned. What numbers do we need to see from AirPods?
Yeah, so Apple doesn't break out individual numbers for the AirPods, but we know the AirPods are a big part of their accessory segment, which also includes the HomePod, the Apple TV, the watch, a few other things. So what we're going to be looking for is an all-time record by a lot, between 30 and 50% for that segment, and I think that's going to satisfy Wall Street. But what Wall Street needs to remember is that the AirPods are so reliant on the iPhone, the Apple Watch as well. And so the real breakthrough will be when the AirPods and the Apple Watch eventually become standalone products. Then that's where the real growth is going to come.
Mark, you mentioned the watch. Google acquired Fitbit. Does that put any more pressure on Apple and the watch?
Yeah, no, absolutely not. I don't think Google has shown an ability to turn any of its investments in hardware into an operation that can compete with Apple on any level, big or small, and I think that's going to continue with the watch. And it's unfortunate because the more competition, the better. But at this point, the Apple Watch, along with the AirPods, are so far ahead of the competition, both in terms of the integration with other hardware, that it really doesn't seem to be any chance of any of these other companies catching up.
I know it is still very early days, but I think every analyst is eager to hear about the early few months of Apple TV Plus and the launch. But at $4.99, I think we agree it's priced for growth, not for margins. What early numbers could we get about Apple TV Plus?
Yeah, I mean, that's an interesting point you make about being priced for growth, not for margins. But I don't know if we're there yet, right? I don't really think that there's going to be serious numbers to talk about until maybe a year from now. If you remember, anyone who really wanted to subscribe to Apple TV Plus probably would have done it already, and they probably already bought an Apple product that actually comes with the first initial free year of Apple TV Plus. So I still think we're a ways away from knowing anything. I'd be surprised if they give any real numbers tomorrow on how TV Plus has fared. I think they would have done so already if the numbers were particularly great. I've seen some statistics out there about how it already has 30% market share in some regions and is really approaching Netflix in some respects. But again, it really doesn't matter until the dollars and cents start coming into play, and that's definitely not going to be happening for about a year.
Mark, the stock is up 90, 100% in the last year. Price to perfection?
Yeah, I mean, you see their multiples. I mean, at this point, it's really hard to understand what's going on with Apple stock. They're doing way better than their earnings would indicate. But I think it's a lot of optimism. Over the next 2 years or so, Apple's going to release about 10 new iPhone models. That's going to be the most amount of new iPhone hardware that they've ever released in a 2-year or even 3 or 4 year period. So that's what a lot of the excitement's coming from.
Bringing it always back to the iPhone. Thank you to Bloomberg's Mark Gurman. And that does it for this edition of Bloomberg Technology. We're live streaming on Twitter. Check us out. This is Bloomberg.